Morning, Market Chameleons and Dimitri Pargamanik. Welcome back, buddy.
Good morning, Will. How are you?
Feels like a long time since we've been on the show. 3 days off with 4 kids takes a lot out of you. I feel like I've been away for like a month.
Yeah, that extra day does seem like, wow, that's a long time.
A lot of hard work. Welcome, everyone. If it's your first time joining, thanks. We do this every day before the market opens for half an hour. Let's start with the disclaimer, D.
Yep. Good morning, everyone. And before we get started, just keep in mind that Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help give you guidance and answer your questions. So there's the disclaimer.
Excellent.
And let's take a look what's going on here.
I didn't mention it at the start of the show, but we do have quite a few chameleons who live in Texas. One of them, Goat Roper's on the chat right now. Poor Texas has been hit with some terrible freezing temperatures, snow in Austin, Texas, power outages, really crazy weather patterns in Texas right now.
Yeah, that's unfortunate. I didn't realize. I did see some headlines there just saying that there was a lot of power problems. So hopefully they work that out. But let's take a look. I think today we'll take a look at, by the way, we're like very, very terrible with these small talk in the morning.
What?
The small talk in the morning. But we'll take a look today at the pre-market movers. Take a look at, I think, what's coming up on the earnings front. Also take a look at a report where we take a look at which option strategies were working as far as like straddles or upside calls in the last couple of weeks. See which stocks have been moving by more than what the straddles were implying. But I'll show you what I mean when we get to that report. And of course, if you have any questions along the way, let me know. I'll try to answer as many questions as I can along the way.
Will do.
So this is the pre-market report. These are stocks that are trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Let's first filter this report and see what's going on in the higher market cap stocks. So I'm going to use this filter. Let's take a look at stocks that are 20 billion market cap or higher. And here I see 73 made it to our percentage gainers list, 11 on a percentage decliners. So from that perspective, looks like a more favorable bullish opening. Looking from the top of the list, the volumes are not huge. Like, ING up 7%, 81,000 shares. You got BHP 46,000 shares trading the pre-market. So nothing really sticks out at me right now. The volumes are kind of muted, just maybe on the downside here. PLTR, they reported earnings. They're down 8%. I believe that's their like first or second report, right? Palantir. Yeah. So there's not a big history there. Down. Here's where it closed, 31.91, trading 29.15 in the pre-market hours, down 8.7%. And you can see here the range in a pre-market as low as 28, high as 34.85, 13 million shares trading hands. And if you want to go look at, their earnings, you could come down here, open up the headline news, or take a look at what they're saying after reporting earnings. Let me do the unfiltered report. See what popped up to the top. So here we see SCKT, looks like a low cap stock, 19.6 million market cap stock, up 240% in the pre-market, trading 16.9 million shares. It looks like they had some news on them, hovering over the headlines here. And, they're up. Looks like they launched some scanners for the iPhone. So you could see here, closed at $3.24 on Friday, trading $10.87 in a pre-market, up over 200%.
Jesus.
If we open here, like way above the 52-week high, $4.50, 17.6 million shares trading in the pre-market hours. So let's just take a look, how that compares to its historical gaps. But if you slide down here are the catalyst news events. So I'll leave that up to you to read and see if that move is justified. But let's take a look at its gap history. So this is looking at an SCKT in the last 3 years, the largest 12 gap moves. Okay, so we got the dates here. This is the gap, the opening gap move. If there's a press release on that day, or we make a note, look of a headline article, or if the market was up, happened to be up big that day, you could see, you just hover over it and see a potential catalyst for that day. But if we take the opening gap moves here and take the average of the biggest 12 moves, we see that on average, that's 27.6%, which is, today's move of 235% is way above that average. And I'm just scanning with my eyes, we had like one move here, July 27th was up 166% in the at the opening. So that was probably the closest we see to today's move. Let's see what it tended to do after opening up, a big opening gap move. So we see here from the open to the high of the day, average move was 2.4%. From the open to the low of the day, the average move was down 13.1%. The drift from the open to the close, it drifted lower more often than higher. So from the opening price to the close of the day, 83% of the time, it closed lower with an average loss of 8.9%, which is just telling us that historically, when it gapped up, it didn't tend to continue higher towards the end of the day. Sometimes it did, but more often than not, it drifted lower, didn't hold on to those gains. And that's, of course, from a historical perspective, you want to take a look what that news is today and see, what you think is justified. But that's just from a price return distribution on, after a big gap move in SCKT. Let me close that. The other, there's a couple other small cap stocks, but I'm going to move on, let you kind of go through these, but I just did one as an example. If there's no questions on it, I'll take a look at the earnings, and I think I'll take also a look at we track historical straddles and out of the money puts, out of the money calls, how they're performing week to week. So I'll take a look at that report as well. So no questions, I'll move on. Let's take a look at this report. So this is from an options perspective, and this is the straddle and wing backtest report. So I'm going to click on this, take a look. So in this report, what it's doing is it's taking a snapshot of different option strategies on Monday around 10 a.m. and saying if you did that strategy from Monday, held it to the end of day Friday, what is the performance of that strategy? So we're taking a look at the straddle. If you just buy the at the money call and the at the money put, hold it to Friday, how did that perform? If you just bought an out of the money call, 25 delta, we benchmark it at 25 delta call, so an upside call. How did that perform week to week? Out of the money put, 25 delta put. On top of that, we also use what if you re-hedged it? So professional traders, besides, they don't just buy or sell an option, they'll use a hedging strategy, hedging their delta. And that's what the strategy, when you try to capitalize on the difference between the implied volatility and realized volatility. So that would be under the hedging, when you're doing delta re-hedging or you just do the option outright. So let's take a look at, in the last 12 weeks, the first thing we'll look at is a strategy, just a straddle. So buying that at the money call, buying that at the money put. I'm going to set this for at least the last 12 weeks. Let's have at least 12 observations in there. So sometimes if the options are very wide, or they look illiquid and we can't take a snapshot, we don't know where that market is, we skip that observation. So I'm going to set this to at least 12 observations in the last 12 weeks. So we're able to kind of, it met our threshold for market width. I'm not going to hedge it. Let's just see if you did the straddle, held it till Friday. Let's take a look at that performance. So unhedged. So I'm going to say just unhedged, buying the call, buying the put, Monday, waiting to Friday. And let's sort this. I'll sort this by highest win rate. So MGNI, you could see here that in the last 12 weeks was a winner 83% of the time for an average gain of 70%. SPCE, that was a winner 75% of the time for an average gain of 28%. Google's up there. That was a winner 75% of the time for an average gain of 35%, which is saying that at least in the last 12 weeks, that straddle for the week tended to be underestimating the move. Okay, that's what this is telling us is happening in the last 12 weeks. So you still want to go in there, take a look. What's going on? Is volatility increasing in the stock? Is it making some kind of breakout? There's news, but at least this is isolating it to see which stocks the volatility has been exceeding the implied moves. So down here we see Twitter. I think that reported earnings that, that straddle was a winner 67% of the time for an average gain of 21%. So if we just open this up, I'll give you as an example, MGNI. So these are the last 12 weeks observations. So this was looking at the last one, February 19th expiration. So if you started on February 1st at 10 a.m. on this options expiration, February 19th, looking at the 35 strike, this is where the spot price was. So the call was 360, the put was 325. If you bought both these, this is the notional value, 685. The straddle was implying a move 19.3% that Monday. Fast forward to Friday, February 5th, the stock was 54.91. That was up 54.5%. So the calls were 20.05, puts 23 cents. So that, you see the contract value here. So this is the return on the straddle. In notional terms, this is the percentage return, 196%. And then next to it, you see if you delta hedged, what the return would be if you were re-hedging the delta. So we're looking right now at this, but this gives you a comparison if you were hedging your delta. So this way you could kind of take a look in the last 12 weeks how that straddle performed. Hopefully that's making sense, as I'm showing it over here. So that's the top of the list: MGNI, SPCE, Google, Rite Aid, NetEase. Let's take a look at now a 25 delta call. So a 25 delta call unhedged, at least in the last 12 weeks. So let me just make sure it's sorted. So the idea here is that the stock was probably climbing, and on average, those options, the out of the money calls tended to be undervalued, right, as the stock was climbing. So here, UIS, we see here, that was a winner 83% of the time for an average gain of 159%. So if we open that up, we see here the history. So I'm just going, you could go back 12 weeks over here, but you could see here that stock has been climbing, from 14, we're at 24.80 right now. And this The last one, February 19th expiration, started February 8th, ended February 12th. So we see here that this call was 28 cents on February 8th. February 12th, call was 38 cents. So that was a 36% increase. So you could kind of just take a look how the call did in the last 12 weeks. If you just bought the call on Monday, held it to Friday. And of course, you want to take a look at, well, what's going on in the stock, what's driving it higher, and if it'll continue, but it's just pointing things out, what's been happening in the last 12 weeks. There are no questions on that. Well, I'm going to move on.
Cool. We had one earnings question when you get to earnings.
Okay. So let's take a look at the upcoming earnings. So these are stocks that are expected to report earnings in the next 2 weeks. I'm going to use this filter here and look for stocks that on average trade 5,000 option contracts or more per day. Let's take a look at the full report. So here we see these are some of the stocks that are going to be reporting today after the market close. I'll just look at a couple of them, up top, and then we'll get to your question, Will. So IBIO, that's expected to report today after the market close. Straddle right now is implying a move of 22.9% in either direction, up or down. Remember, we're buying a call, buying a put. That's premium, looking at the magnitude of the move in either direction, up or down. So right now, the straddle is implying a move of 22.9%. That compares to a 4-quarter average move of 14.5%. So that's what the stock's realized move was in absolute terms in the last 4 quarters, 14.5%. In the last 12 quarters, stock average move was 7.3%. So we're 8.4% above the 4-quarter average, 12%, 15.7% above the 12-quarter average. The high move on that stock, 24.4% in the last 12 quarters. GNW, that's also expected to report today after the market close. Straddle's implying a move of 14%. That compares to a 4-quarter average move of 6.7%, 12-quarter average move of 3.4%. High move on that stock, 10.7% in the last 12 quarters. So we see 7.3% above the 4-quarter average, 10.6% above the 12-quarter average. I'm going to kind of slide down to the stocks with higher option volume. So we've got Shopify. Well, that's tomorrow before the market opens, but we're seeing that the straddle here, as of Friday's close, is implied move of 7.7%. That compares to a 4-quarter average move of 6.6% and a 12-quarter average move of 5.9%. High move on that stock, 12% in the last 12 quarters. These two are coming up today. AIG, that straddle, as of Friday's close, was implying a move of 5.9%. That compares to a 4-quarter average move of 4.7% and a 12-quarter average move of 4.7%. So we're 1.3% above the 4-quarter average and 12-quarter average, with a high move of 9% in the last 12 quarters. Let's do this last one, and then we'll go to the question. DVN, that is expected to report today after the market close. That straddles implying a move of 8.1% in either direction. That compares to a 4-quarter average move of 4.9% and a 12-quarter average move of 4.6%, with a high move on that stock, 11.8% in the last 12 quarters. So we're 3.2% above the 4-quarter average and 3.5% above the 12-quarter average. So what was the question you had?
Well, we had a question about it. It's a stock like Palantir. That was earlier from Sam, which we can get to. But someone was also asking if you could dig deeper into Shopify, SHOP.
Okay. So let's take a look at SHOP. So here we landed. This is going to compare the expected historical move according to the option prices prior to releasing earnings versus the actual earnings move after releasing earnings. So when we look at this bar, you could see it starts from 0% going up and down. So I'm going to use this one I'm hovering over as an example here. So October 29th, before the market opened, the Shopify reported earnings. You see that the stock was down 4.8% that day. The straddle was implying a move of 6.6% prior to earnings. So you could see that that move was more muted than the straddle was implying. The green, that green bar, that's when the move was to the upside. So July 29th, before the market opened, Shopify reported earnings. That day they were up 7%. The straddle was implying a move of 8.1%. So that move was more muted than that straddle was pricing in. So let's take a look at the historicals. That in the last 12 quarters, the straddle overestimated the move 75% of the time. The average expected move prior to earnings was plus or minus 8.4%. The average realized move was 5.9%. So you could see there about a 2.5% differential between the implied move versus the realized move. That's why we see here that straddle was only profitable 20% of the time, and on average lost 24% after the day after earnings. And you could see here, where the time it broke through, like over here, here it came close, but this gives you a visual. And it looks like, at least from a historical perspective, when it broke through, it was really to the upside. So that's from the perspective of the move. Let's take a look at the implied volatility, what it tended to do. So this is going to look at an option that's 30 days to maturity. And the reason is when you look at the very near-term options, those have less vega, they have more gamma. So basically more of the move is priced into the very short term. As you go out further, the options have more vega, so there's a bigger implied volatility risk. So we're looking at an option with 30 days to maturity. And this is what that option tended to do. So on average, the implied volatility was down 18% day after earnings. So heading into earnings, the 30-day IV was on average 58. The day after, the average implied volatility fell to 47.9. 5 days later, it fell to 46.4. So it continued to decline 5 days later. So here, this is the average 58. Here's where we are now. So right where the average is, 58.4. All right. And if you come down here, here are the historical snapshots of the implied volatility, heading into earnings, day of earnings, and how the implied volatility behaved up to 5 days after earnings. And you could see here the averages, the max and the min. Averages, max and min. Okay. So that's really quickly from looking at the straddle and the implied volatility. Let's take a look at what SHOP did since it last reported earnings. So in this situation, actually, before I do that, we have some time. Let me take a look at what it did historically as far as that. So this is looking at the historical earnings. We're looking at what the estimates versus the earnings per share estimates versus the actual, also the revenue, the estimates versus the actual. So you can see here, the last time they reported earnings, expecting 51 cents, they reported $1.13, they beat by 62 cents. You can see the revenue, they're expecting 653 million, they reported 767 million, so they beat on that, but the stock was down 4.8%. So you could see they beat analysts' expectations, earnings, and revenue, but the stock was down 4.8%. So why is that? And you see this throughout, and I try to point this out almost daily on the show. So the reason for that is the following, there are two reasons. One is that these top numbers, they don't tell you the entire story. It's the story behind the numbers. What is the management saying about the future? What is their outlook in the future? Because even if you beat, right? And you could beat by a lot, but whatever you say, maybe you could say like, hey, our patents are running now, or, you know, you could say there's going to be new competition coming on board. So things that you say in that report will impact the stock. The other reason is that the stock price, this stock price does not reflect an analyst expectation, right? The stock price reflects the traders' expectations who are buying and selling the stock, right? So it's not the analysts that are setting the market price, it's the traders, and it's really their expectations, and how and what does the stock do relative to the expectations of the traders. So it's the risk holders that are really, that's the important part. So let's try to gauge what they're thinking, okay? Like how are traders may be feeling about this next earnings. So one thing we could do is, first, let's just take a look at what we think the fair value is of Shopify, okay, and where it's trading. So this way we could kind of benchmark, well, where would Shopify be priced at according to their historical multiples versus today's price. So here I'll show you really quickly. This is looking at, in the last 3 years, what's the average on the last 3 years, what's the average PE ratio? So here it's pretty high. So we kind of skip that because it's not very stable there. So we'll go then default to the price to sales ratio. So the price to sales is the market cap of the stock divided by the total revenue it earns. And here we see that on average, it's been 54.8. Its average price to sales, we see it's much higher now. So if we go back to the average, that's where we are. We could also take a look at relative to the SPY. So I'm going to skip the PE because it's been kind of all over the place. We're skipping that. So here's Shopify's price to sales ratio versus SPY's. So right now you can see it's at a huge premium. This is the 3-year average premium of Shopify's price to sales versus SPY. If we revert to that, we're here. So we could see that if we use those averages right now, we're at a 31.5% premium. In other words, that currently the traders are giving it a higher multiple, higher valuation than average. So at least here they're looking a little bit more optimistic heading into this earnings than usual. I'm going to also take a look at the post-earnings drift. So this is looking at what did the stock do after reported the last earnings. So we know that we just saw after reported the last earnings, the stock was down 2.8%. Since then, we have about 3 months in between where the stock doesn't report earnings, but it can drift, right? It doesn't stay at the same level. It'll drift higher or lower. So here's this green bar here. Since then, the stock over here drifted higher by 49%. Well, how does that compare to what it does usually between earnings? So we see that the average drift historically has been up 19.9%. The average move up or down between earnings has been 16.6%. So that's a 3 standard deviation move to the upside relative to its historical moves. So at least here we're seeing that based on historical benchmarks, Shopify, the traders look like they're pricing in already a optimistic earnings report from Shopify. We ran out. We're right at 9:29, Will. So I don't know if you have one last question, but
well, really quick. Someone was looking at QS. It's its first earnings. All we could basically look at is what they're pricing the straddle at. Maybe a quick look. QS.
This one. QS. Let me see here. I don't have an earnings history here. There must be like their first one.
Yeah, I think it's their first one. That's what I said.
Yeah. So there's nothing as far as like an earnings history. There's nothing to look at. It looks like their first one, and we're right at 9:30. So I'm just going to stop there.
All right, great. Everyone have a great day. Dima, awesome job. Thank you so much.
All right. Thanks everyone for joining us. Stay safe. Have a great trading day. Hope to see you guys tomorrow.